Welcome back to Halftime Report on CNBC TV 18. Let's put the spotlight on Nazara Technologies, a mixed set of numbers that came in Q1 FY26. New acquisitions like a Curve, which was acquired last year, one full year over there, that's managed to do good growth. Smashes, that's come in as well in the offline side of the business. Gaming business has done well, but the bit of a subdued performance that came in from Sportskeeda, Pokerbazi, muted set there. So what is the outlook of the company going forward? What are we watching out for in terms of overall the growth from the offline business as well? We have Nitish Mittersain, who's the joint MD and CEO of the company, to talk to us about the numbers. Nitish, good afternoon and thank you so much for giving us your time. Let's start by talking about your overall growth story that's coming for the gaming side of the revenue business. Good growth, whether you look at it sequentially or year-on-year basis. Now, how have the sub-segments done in this side of the business, as well as in terms of contribution that you've seen coming in from the newer acquisitions? That's Curve as well as Smash. How is that performing as well?
Sure. Our gaming business, year-on-year has grown close to 160% in revenues and contributed over 300% year-on-year growth in EBITDA. I think our strategy of building, core gaming, established IP-first businesses is paying off very well for us, and we will continue to do that. We've acquired new businesses in Curve Games, which is the first entry into the PC and console space, and a few sports games, which makes a Love Island game, is now launched. Big Brother, we're launching Big Boss very soon. So I think we've got a series of very well-known IP coming out, and we're very excited about this gaming segment, high EBITDA margins as well.
Okay. Nitish, hi. Welcome to the show. Just wanted to understand what's taking place with Kidoppia. It's seen 9 consecutive quarters of a decline in subscribers.
Yes, I think we've been working a lot on it, but it's obviously taken much longer to recover than we originally anticipated. That said, if you look at this quarter's results, overall KPIs seem quite good. Our cost of acquisition has reduced. Most of the KPIs you look at, like churn, etc., have improved. So I think we're getting there. Hopefully, the light at the end of the tunnel is there, and we should start showing some growth in the coming quarters.
What about, esports? That saw 29% decline quarter on quarter. Nodwin as well, continue to report EBITDA losses. What's the turnaround plan for that? And what really was the rationale behind, you de-subsidizing Nodwin?
Sure. I'll speak about Nodwin first. As you know, Nodwin has been the market leader in esports, and they actually continue to grow quite a lot on revenues. Year-on-year growth is 49% for this quarter, and I think this whole year revenue growth is going to be quite significant. The Q1 saw slightly exaggerated EBITDA loss of 11 crores, but I think they will catch up in the rest of the year. And we're quite confident that this company this year or latest by next year will be profitable. So I think maintaining market leadership for Nodwin is important. And in that context, they will have to raise more capital and aggressively grow the business. Now, from a Nazara perspective, as you can see, our gaming segment is, our core gaming segment is generating high margins for us, very healthy cash flows. And we have a lot of attractive opportunities to invest in that business, both organically as well as potentially new studio acquisitions. So we kind of took a call that at this stage, for us to invest more capital in Nodwin versus investing into our core gaming business, that was a capital allocation priority that we have done. And this also, the deconsolidation allows Nodwin now to go out and raise funds from external investors, which can potentially aid a lot of their growth. It's important to remember that we own a large stake even post deconsolidation. We'll probably land 46-47% ownership. We are the largest shareholder, and therefore, Nodwin growing aggressively and building a lot of value for us will be very useful for us in the longer period. As far as Sportskeeda is concerned, this quarter has definitely been a disappointment for us. That's a company that's been on a fast growth track in the last 4 years and been highly profitable for us. Unfortunately, due to some external changes at the Google end, the March Google update kind of destabilized the Sportskeeda.com traffic, while their other properties continue to do quite well. So we're taken a couple of, we've reduced costs, we've reduced content costs, we've right-sized the teams, and hopeful that this will recover in the next quarter or two.
So you're expecting recovery in the next quarter or two for Sportskeeda. Just two questions that are from my side. One is in Kidoppia, the margins. This time you said that there is some royalty cost that comes in as well. So now this is what you'll be paying every quarter. Is it yearly? When do we expect this impact to actually, come in every year? As well as in terms of ad tech business as well, what is the outlook there? Because sequentially we are seeing a decline there. So when will you start seeing those synergies come in for data work, space and time acquisition that has come in as well?
Sure. So on Kidoppia, we have partnered with global IPs, such as, with Mattel, we have a partnership for Barbie, and we have some stuff happening with Hasbro, etc. So these are revenue shares we pay on a monthly or quarterly basis. Initially, you're seeing a slight, decline in EBITDA margins, but over a period of time, the IPs will actually drive a lot of organic traffic, so our cost of acquisition should come down, and the margin should go back to where they were. In terms of the ad tech business, we are starting to see, good synergies play out between space and time and DataWorks, the cost side as well as on the product and revenue side. So again, I'm sure this year we will see, those margins come up and those synergies kind of play out.
Okay. Nitish, just quickly before we let you go, what is the plan in terms of scaling up the offline business? How much is it going to probably be a percentage in terms of total sales going forward, and how important a segment is it going to be?
I think it's a very exciting space for us. We have two assets or two IPs over there. One is Funky Monkeys, which is for younger kids. Funky Monkeys had about 10 centers when we acquired it. They are up to 14 or 15 now. And now the launch rate has increased a lot. We're launching at least a center a month and hoping that over the next 2-3 years, we should be able to take this to 75 to 100 centers. I think there's a huge potential in our country for this kind of format. And, even 500 centers could be, hosted in our country. So I think profitable business, quick break even, and we are pushing very hard on that. Smash for us is a great IP that we've, acquired. It requires a little bit of stabilization and reinvention. So you will start seeing growth over there in FY27. But there's a lot of synergies that we see that we can bring from the online Nazara, what we do, into these offline activities. And we also believe that, consumers increasingly, especially the youth, want to go out for social, interactive entertainment experiences. And the share of wallet will keep increasing over there. So I think it's a great space for us to operate in.
Wonderful. People do want to go, Nitish. It'll be very interesting to see how much they can afford it right now. And secondly, how profitable as a proposition it is for you versus esports businesses or, online gaming where the margins are obviously a lot higher. But that conversation for another time. Thank you so much for joining in. With that, we'll slip into a short break. As we do that, let's give you a reminder once again. Unlock a world of exclusivity, expertise and influence. Become a member of CNBC TV 18 Access, our premium members-only experience on cnbctv18.com. The membership includes access to CNBC TV 18's flagship events, interactions with our journalists along curated studio tours, e-learning sessions and masterclasses along with lifestyle benefits.